key thing I've gotten wrong in this last year is how much the Fed has hiked rates. I didn't think they'd go this much. I didn't think I'd see the 12-month, the one-year bill in the U.S. at 5.44%. That's the highest since 2000. It's 23 years. Bitcoin has been around for 9,000. So first I'll rope this over to I see the problem with Bitcoin is I look at it as a parent. My kids are in almost 30, some of them now, and that is that this teenager has never seen a world without zero interest rates, massive liquidity, and now it's completely the opposite. In addition, part of that, the engine of growth in the world and that bastion of trading from China is just reverting. Now that's the process right now. It's a question of what stops these things.
Wall Street ended higher on Monday with gains in 3M and Goldman Sachs ahead of key inflation and jobs data this week that will offer more clues on the Federal Reserve's interest rate path. All three major stock indexes rose as investors digested last Friday's comments from Fed Chair Jerome Powell that the U.S. central bank may need to raise interest rates further to ensure inflation is contained. Focus now shifts to a report on the Personal Consumption Expenditures Price Index, the Fed's preferred inflation gauge to be released on Thursday, and non-farm payrolls data due on Friday. The fact that Powell didn't come out and say anything particularly hawkish or particularly unnerving to markets, that has proven to make this a bit of a risk-on day, even if he wasn't outright dovish either, said Ross Mayfield, investment strategy analyst at Baird. Bloomberg's senior commodity strategist, Mike McGlone, shares his macro outlook on the state of the economy, mentioning the interest rate hikes and what he sees coming from it. He also went further to discuss the housing market sector and his predictions on what would happen next. As you now get into the video, don't forget to drop a like, subscribe, and drop your comments below.
The simple fact is you look at Fed fund futures, I look in the terminal, the functions WRP, and it says the expectations for the September meeting is they'll hike another 25 basis points, that's 20%. And for the November meeting, 40%. The bottom line is they're still hiking, and just got off our meeting this morning with my colleagues, and the economist Anna Wong says they might misinterpret the data and hike more. It's just a simple way of saying, don't just fight the Fed, fight the most central banks on the planet that are still tightening, with the exception of one, China. And China is the second largest economy, and they're in a significant, I think, reversion period. So that to me is the most important thing. So I think the most important thing for someone like me to do is focus on what I got wrong and what it matters. And the key thing I've gotten wrong in this last year is how much the Fed has hiked rates. I didn't think they'd go this much. I didn't think I'd see the 12-month, the one-year bill in the U.S. at 5.44%. That's the highest since 2000. It's 23 years. Bitcoin has been around for 9,000. So first I'll rope this over to I see the problem with Bitcoin is I look at it as a parent. My kids are in almost 30, some of them now, and that is that this teenager has never seen a world without zero interest rates, massive liquidity, and now it's completely the opposite. In addition, part of that, the engine of growth in the world and that bastion of trading from China is just reverting. Now that's the process right now. It's a question of what stops these things. So I look at this in terms of the big picture macro is, don't fight the Fed. We've had this bounce in the stock market. And the key thing that's still happening is I don't think, and it's just showing that the Fed's going to lighten up on that tightening button until the stock market goes down. So what does that mean for all risk assets? They typically go down. Definitely for all the altcoins, Bitcoin, maybe at some point it'll look back and say, okay, up 26,000 X's since it traded one in 2011. Maybe it reverts a little bit of that. To me, that's the risk in the macro. And the key thing is what changes this. Now, to me, the thing I did get right is I thought China was going to go the way of Japan and Soviet Union, as you read in things like the book, like Atlas Shrugged. It is going there rapidly now. We heard from our strategist in Hong Kong this morning, and says China's not done easing and the Fed's not done tightening. That's the train wreck happening. Strong dollar, in the world's most significant currency, weak currency in the other one, and sentiment's poor. What changes that? Nothing. It's not. We haven't seen the accumulated effect of all the rate hikes in their best customers, and then there's this war going on. So there's the issue with China. Most cryptos are traded in Europe, and the key thing that really struck me this week was when I heard you say this weekend, Scott, that it's not the store value, it's the value to be stored. That is what I'm expecting: is total value, total monetary value of assets on the planet to decline. Now that's happened a little bit. It's happening with housing now. It's just getting started. It's stock market's bounce. In China, it's happening. But if it has a normal reversion that is historically, we can take that GDP around 17, 18 trillion and knock it back a few. It's just what always happened. China, look at Japan. Its GDP has been the same for about 30 years now.
30 years. Yeah.
Yeah. So this is I'm not gonna make it long-winded, but it's just the key things that are the bottom line for me is these are significant macroeconomic trends that are in motion. And the bottom question, the bottom line we have to ask ourselves is number one, where we're from. And where did we come from in markets? We are talking about, in terms of Bitcoin, the best performing asset in history that potentially will revert more. That's my bias. We're talking about the stock market just a few years ago by 4 or 5 metrics was the most expensive in history that just may revert more. And then we have the most significant monetary authority in the world that's indirectly saying, okay, it's time to cut that umbilical cord of all risk assets being dependent on us being there every time they drop 20%. That's a body in motion. Yes, I've been early, but at some point, gradually and suddenly, I think it's going to kick in and all risks go down. And even our chief interest rate strategist, Ira Jersey, pointed out there's pretty good risk reward, that 2-year note yield at 5.05%.
In July, the rate of single-family mortgages that were considered seriously delinquent, defined as late on payments by 90 days or more or already in foreclosure, was unchanged month over month at 0.56%. According to Freddie Mac, the rate was down annually from 0.73% since July 2022. For Fannie Mae, the other government-backed mortgage finance giant, serious delinquencies fell to 0.54% in July from 0.55% in June. In a Monday edition of his newsletter, Calculated Risk, veteran real estate expert Bill McBride pointed out that this is the lowest rate since before the housing bust of 2008, as well as below the pre-pandemic low of 0.6%. Let's now watch as Mike McGlone shares his view on the housing market.
Since when is spiking mortgage rates good for any type of liquidity in housing? So existing home sales have collapsed. We get that. That makes sense. And what's spiked up? New homes under construction, about the highest ever. And the last time we had a similar high in this was when we had the big, well, it was around 2006, and then well before that in the 80s when we had boomers who were buying. Now they're, get me out, but it's a classic sign of a cycle in a market. We have this initial period where, okay, existing home in sales are inventories. Now, first of all, we teach the number one rules about inventories are low inventories and high inventories. Prices always peak when inventories are low, and they always bottom when inventories are high. I remember pointing that out in crude oil about 1.5 years ago on live TV, and they thought I was crazy. I'm like, well, I'll show you the facts. So that's what's happening. The thing is, now they're going to the new homes under construction. They're making this supply kick in because they're giving them favorable deals. They can give them lower rates. And it's classic going to kick over until massive supply kicks in. The whole thing's tipping down. The bottom line is don't fight the most significant fact in the planet here, and that's this Federal Reserve still tightening. So that's just starting to kick in. I mean, come on, you see it in condos in Miami. I've seen people involved in it. And then people I just meet, I own this property and that property. It reads very much like The Big Short. So many people own what, and here's a key leading indicator we did not have during the last recession, Airbnbs. They're collapsing. I mean, this was a quote from our economists a little while ago. They're just starting to, and that's going to be a lot of overextended. So that's the one thing we need to remember where we came from. We're just coming off the longest extended period of zero interest rates on a global scale ever. What does that make people do? Take too much risk in areas they shouldn't be and seek yield. Now they look over that two-year note, as Dave said, to me, that's the giant sucking sound, as Ross Perot used to say. And it's overwhelming, but to me, this is how markets work. The key thing I'm concerned about, and I have to point out my fears, is what Benjamin Disraeli said. What we anticipate settlement occurs. What you both said, and we all said about Bitcoin, things we've known for 8 to 10 years. And here's the inside scoop. When I started pointing these things out inside at Bloomberg, and when they did not want to, we're not in any hurry to be in space, that's when I was so bullish because I felt like a contrarian. Prices were low. This big firm doesn't get it. And then they kicked over. Now it's completely in the masses. What you said is a known. I go to parties and things. Everybody says the same thing. I have to admit, my contrarian bent is up. When everybody says the same thing about the best performing asset in history of mankind, you got to be careful. So, but housing is it's not only what's housing in this country is a train wreck. Early days, but look what's happening in China. It's just getting started.
China has made its housing crisis worse. The country has enough new apartments to meet 7 years' worth of demand. This can cripple the country's economy, as per the New York Times. In China, the pension akin to Social Security in the United States pays about 410 USD a month to seniors who live in cities and only 25 USD a month in the countryside. Public health care covers less than half of people's costs. Unemployment insurance provides around 220 USD a month. The US average is nearly 1,700 USD. The country's consumer safety net is full of holes, even when accounting for lower costs of living than in the United States. As growth has faltered in recent years and now as a simmering real estate crisis ripples through the economy, China is seeing the consequences of its failure to establish robust social assistance programs. Policymakers in Beijing, who have a long-standing aversion to financial protections for households, have begun trimming social spending this year. That could further harm the country's already sputtering levels of consumer spending, in turn dragging property prices even lower. Real estate and consumer troubles are also exacerbating dangers posed by very high debt among businesses, households, and local governments. Prominent economists around the world and inside the country have urged it to do more to support its consumer economy and to stop relying on growth built on speculative construction of apartment towers and heavy public investment in infrastructure like roads and high-speed rail lines. The World Bank and a Chinese government planning agency boldly made the point in 2012 with a report, China 2030, that called for China to support consumers better and embrace a turning point in its development path, as per the New York Times. Since then, China has mostly doubled down on investments to generate growth. The biggest industry by far over the last several years has been building apartments, not consumer-oriented services like travel or restaurant dining. What do you think about the imploding of the Chinese economy? How does it affect the global economy? Let us know your thoughts in the comment section below. Also, don't forget to like, subscribe, and turn on notifications for future videos. Thanks for watching.